Hey guys, welcome back to the Capital Mindset Show. We are your hosts, Austin and Fabio, and today we're going to be talking about 5 airline stocks. So without further ado, let's jump right into this. We're going to be talking about what the businesses are, what they sell, who the customers are, as well as the financial current performance of the of the company, and then also a discounted future cash flow model of the company as well. So what are we looking at here today? I don't know why I said city.
Well, we're going to be discussing a couple of them today. And the first one, I guess, Austin, you have a choice between, we left out United, but you know what? Screw United. So
Yeah, screw them.
Let's go Delta or American Airlines. You pick.
American Airlines. Let's do that from the start.
American Airlines. So with American Airlines, what do you know about American Airlines?
It's an airplane company.
It's an airplane company.
Much as I know.
All right, yeah. That's fair. It is an airplane company.
Okay, so what typically distinguishes businesses in the airline industry? Like, what do they? I mean, other than obviously flying people from point A to point B, but what are some of the nuance things that distinguish them?
So you want to look at efficiency, right? So airlines have to make a profit. It's a very difficult business. In fact, there's a lot of different things that go into the profitability at the end of the day. So what prices they're able to secure for fueling, that actually means that they have to have really good people who understand the futures market, and they're able to secure fuels at favorable prices going into the future and securing those prices using futures, right? That's one way they can do that, as well as securing good planes at good prices. And we've talked about some of the plane manufacturers in the past. Specifically, we spoke about Boeing, and we also spoke about Airbus, right? So there are others, but those are the major 2 that we've discussed here on the channel. And so now we were looking at those as the picks and shovels play. So these guys are the consumer facing parts of the business, and they're the ones that you'll utilize in order to travel the world. So the first one, American Airlines Group, is considered to be the riskiest. And we'll talk about that as to why. So the grand majority of all airline companies that have ever existed, are they still with us, Austin?
I would say yes. Are they?
No, they're gone. No. Most of them are gone.
So
this is a very difficult business.
Is this an industry that typically has a lot of high business turnover? Some businesses come in and then they're gone in 10 to 20 years. It's interesting that you say that this is. Have I heard of Pan Am? I actually have heard of that.
Yeah,
I have heard of that.
A long distant memory.
Yeah.
Of a word not used anymore. Yeah. So your father might know Pan Am if you ask him.
So that's interesting. How do airline companies then come up with the competitive edge?
Again, like I was just saying, efficiency.
Yeah, price. Yeah,
pretty much it. Efficiencies.
Yeah.
So doing the same job efficiently, having more routes that they can do, building better relationships with businesses for business travel is a lot. How a lot of them dealt with it, right? Making partnerships with hotels, so you bundle, and then travel companies, right? Like booking.com, stuff like that. So there's all these tiny little efficiencies that they can do to try to get the edge over their competitors. And the difficulty is that the actual operations are very expensive, as American Airlines can tell you, with their mountain of debt. And we'll actually talk about that. So American Airlines, I can tell you right now, will probably appear to be the cheapest. And it's without a doubt because of the debt levels that they have. So American Airlines has restructured itself many times. And it would be very sad if it goes bankrupt, because all those people who bought the, I think it was like the Gold Pass, where I think Mark Cuban owns one of the Gold Passes, where you get unlimited tickets or flights. And it was like a certain one-time payment back in the day. And if they were to go bankrupt, that would go away, which is unfortunate. But American Airlines, I'd say, is the most likely of the ones that we're going to see today to go bankrupt. Okay. And that is not a credit score. That is a CPD score, right? So you see, it's the grade for climate change. Okay. So let's not get ourselves on credit scores. Okay. The credit score for American Airlines, I think, is barely it's barely investment grade, or it's below investment grade. I think it might be below investment grade. All right. So this is one of the major airlines, though, with international exposure. So you can take American Airlines and travel internationally. Some of the ones that we will talk do not have that kind of exposure, but the one of them is trying to get there. All right. So with American Airlines, I think we can go ahead and just hop into the model. All right. So back for when we were doing Tesla, let's actually switch this over, and then let's erase all this. And let's actually create our own growth rates. So they've been diluting you for quite a bit. And so remember I highlighted
decaying. Yeah.
It will be the cheapest. And right here, it's telling me that if cash flows remain stagnant, it's a buy. But, right, there's a but. But what about that debt? Look at that enterprise value versus the market cap. So I see here they have more debt than the market cap of the business. So the equity portion is bound to be pretty low. The book value is negative. If this company goes bankrupt, you are owed nothing. Analysts have this as a whole with a 15% increase in terms of their expectations of the value. However, what are we going to say about this? So they have a growth rate decay of negative 1.36%. So negative 1%, we'll do that. And then let's grow up to 5% per year. And let's discount this because I believe that including yes, I told you it's cheap. I did say that. It will be the cheapest one. All right. So mind that. Okay. And then we'll grow from 4, 3, and then we'll do 1. Okay. So even at 20% discount rate, even assuming a dilution, we are going to see that they do have a favorable price action. Now let's increase this dilution to even 5%. Let's increase it to, oh, didn't mean to do that. I apologize. Negative 5%.
Oh my goodness.
Oh yes, my friend, 9%. So if they dilute you the same as they've been doing in the past, which I think they probably should try to maybe do that a little bit to get rid of some of that debt. That debt is very terrifying. Then we're looking at, and let's see, yes, Altman Z score, not scoring too high, but my own measure saying coming out as a yes. So that's the risk. This is not for free. This is not free money you're finding on the ground. However, if you somehow know that they will not go bankrupt, this is interesting. All right. So I'll say it on record, just in case it does go bankrupt in the next couple of years, where it has to go through some restructuring event. The model is telling me that is a very likely risk. Okay. So that's why it's cheap. I did tell you that at the beginning of this video. I'm showing it to you now. This is cheap for a reason, right? And let's see how much we can discount this guy. Okay, we can't discount at 25 with that dilution rate, but we can still, that's a pretty good discount rate, okay? So we can assume a 1% growth in cash flows. We can almost assume a 1% decay with a 9% dilution, and we're good to go, okay? So that being said, let's look at the key ratios. Let's see what the damage is. Okay, so terrible. Usually across the board, this is indicative of how the dire straits they're in. They've diluted the absolute living daylights out of you in the last year, and that's how their current ratio has become positive. But you can see they've been generally
significant debt to capital ratio there too.
Yep, look at that. This disgusting, terrible, terrible. So right here, they've probably been having to bring down ticket prices or the fuel expenses. I don't think it was the fuel expenses because 2019 fuel expense was very low. We all remember back in the old days when fuel prices were not as high as they are today. So the margins are definitely going to be crunched, especially if they're being price competitive. And on top of that, fuel prices are going up. You know, that's not so good. ROE, it's probably only positive because the net income was probably negative, if I'm being honest. Return on assets, but we'll take a look. See here. All right. Oh, warning signs. As soon, well, you see how, oh, perfect example, Austin. Perfect example. So correlation. Remember, I say that a lot. Correlation. So here, there is a correlation between the decay of the earnings quality and the decay of the business, right? So even though the earnings quality was good, right, we did see decay decay again, big decay, and decay yet again.
Yeah.
So it just because it's scoring good, remember that's not the point of the measure. It's to see improvement. We want to see improvements, and we're seeing decay. Well, guess what the stock price did?
It's been decaying.
It's been decaying. I put it on max, but I've been measuring since about 2017. So decay, decay, decay again, and decay again, right?
Ooh.
So correlation's pretty strong there with that measure yet again. And we shown in some videos where it's improving, and then you see the opposite correlation, a correlation with improved stock price. Okay, so book value per share is negative. Yeah, makes sense. There are tons of debt. Okay, terrible. It sounds like I hate this company. I don't hate this company. I'm just looking at the numbers.
You're just saying that it is. It is.
I don't
what
really
it
care
is.
about this.
The numbers are telling you a story in this.
Actually, one thing I'll highlight is this: loss of power.
Cycle.
Yeah, loss of power with the consumer.
Major loss of power. I mean, 2020 loss of power makes sense though, given the nature of what was happening in 2020. That makes sense to me. That also makes sense to why we're seeing a spike in things that typically we like to see go lower in 2020. That also,
Austin's wording it perfectly. Very good. So looks very cheap, Austin. Was I lying to you?
You were not lying to me. It's just, it's likely, I think it's likely cheap because it is likely to go bankrupt. But
that's the risk. If somehow you know that that's not the risk, then this could be a very good investment. Very good investment if they can turn it around. But that's the risk. There's no such thing as free money sometimes. Not sometimes, most of the time. And this is no exception. So yeah, not looking too good. Oh, actually, there's one more adjustment I think I forgot to make. Yep, this was actually on there. No, this is actually not even. This is probably taken into account. We have to lower that to the average. Yeah, she don't look cheap. So apologize for wasting everyone's time for that part of the beginning.
Look at that dip in sales too. It's just kind of just a side comment, but
so the inability of them to actually do good on that cash flow conversion is probably going to be to their detriment going forward. And if they continue to dilute you at those rates, it's not going to be good. So if they, let's say they don't need to dilute you as much and that we lower that to about 5%, that's not looking too good here either. So even if it was cheap, it's still not cheap enough, clearly.
Yeah.
Sorry, hold on.
It's basically what I'm all right.
All right. So
moving on to our next airline company in this regard. Let's go with Delta. How does Delta sound to you?
Delta?
Sounds good.
Delta sounds good. Let's talk about Delta.
Sounds
so what
like
what are your opinions or preconceived notions about Delta Airlines?
I remember I think it was the video that came out where they were dragging a passenger off the plane, and then other than that,
so you have a fond memory of Delta.
Yep.
So
nothing like some good old consumer goodwill,
Yes. So Delta going through a similar story, except I'll tell you right now, before we even look at it, the balance sheet isn't as destroyed as American Airlines. American Airlines is absolutely terrible balance sheet. And remember, from summary of what we just saw with American Airlines, after I forgot to adjust for some of the long-term assumptions on cash flows, it's definitely an avoid. I would avoid that. It's not cheap whatsoever. And the risks just don't justify it. Okay. So we should probably put also like a little note to say, oh, look when it adjusts, because some people might click off right there, and that'll be the message that they take. So just out of an abundance of precaution, I would do that. And then Delta, what we can see here is they still haven't recovered. They're kind of coming down from the Omicron variant concerns. So let's go ahead and jump right into the model, because I don't think we need to talk too much about the price action, but we just type in DAL, and then let's take away these growth rates because they're not feasible. Let's discount it at 10% starting. And then right here, you see we have a long-term price to free cash flow. Sorry, not price to free cash flow. Cash flow conversion rate of 7% is what we're assuming, which is what they've averaged in the past. So then we can take that into account, where they have been diluting us a little bit, but they have averaged out at a little bit of a buyback. So let's say they do continue to buy back and they do it at 1% per year instead of diluting us. And then we have some growth rates. So going forward, we might have, let's do a negative 2% as they continue at current rate. And then let's do a 3%, 4%, 5%, 1%. So at 10% discount, that's just simply not enough for me because of the risks associated with this industry as a whole. I would need this to be extremely cheap. Okay. And this is the risk that have always existed. I don't like to invest in airlines. The value has to be quite compelling for me to think about it. So that's just a rule of thumb for me. Analysts say it's a buy, so just listen to them, I guess. And they put it at a 53 price target, implying 50% upside from here. So that's their take. My take is not so fast, very bad industry. You need a huge discount in order to justify an investment. So going to the key ratios, because we're going to zip through this, guys, because there's a lot of ones we need to talk about. All right, terrible, terrible, terrible across the board.
Yeah. There's
Earnings
nothing much
quality,
I can really even. Oh my goodness.
good,
So,
good, good. Decline, decline. Let's go back. See that correlation, baby. Good, good, good. Decline. That correlation's there. Anyways.
don't you have to take that number in absolute terms then?
Yeah. I'm sorry.
Yeah.
I did a brain fart. I forgot my own rules.
Yeah. I was like,
So-
wait a second, because
No,
I'm
no.
seeing a correlation there where it's like, boop.
You're good.
But that's
Well,
not causation. That's
I-
just, yeah.
I was thinking something and I said another thing, but this is what I meant. Like, you see the correlation, it went up.
Yeah.
It improved. It improved from before.
Mhm.
So there was the correlation there. American Airlines actually went against the correlation slightly towards the end, because if we remember, American Airlines actually has went up, even though it declined even further. So remember, correlation, not causation. So going back. Oh, wrong one. American Airlines. Here we go. So book value, terrible. Okay, so moving on.
Oh, wow. I mean, that makes sense why that was such a huge drop again, given the macro of what was happening in
The
2020.
debt. It was the debt they took on. So let's review that story from the numbers. Look at that. Look at that debt.
Yep.
Look at that debt. Book value therefore goes down because your liabilities are rising dramatically. Looking here, okay, they're good. Delta, I prefer over
Not too bad.
American. I'll just tell you that right
Yeah.
now. If you put a gun to my head and I had to invest in one, it'd be Delta. Even though I don't think that the price currently reflects the probable risks. You can see here, my model is telling me red flag, be careful. Okay, so now I guess we're moving on to the next one. We're zipping through this. Next one, you get to pick Ryanair or Spirit Airlines.
Let's go with Spirit Airlines for the next one.
I didn't want you to pick that one. Can you? No, I'm kidding. I'm kidding. Kidding. Everyone. Austin, calm down, please.
Don't worry. I am as calm as I can be when we review airlines.
All right. So which one do you have? Do you have a favorite so far of the ones we've spoken about?
I liked Delta better than American Airlines. I definitely
You're not American enough.
No, I'm like kind of here just enjoying, seeing what story these companies are telling us.
So here with Spirit Airlines, we see kind of like a similar story of struggle. Yeah, so sad if you've been an investor for the long term, especially if you've been buying back here, you're down about 73%. And if you've been buying since the IPO, you're only about 85% up. So the whole time, terrible performance. You would have done way better investing in index funds. Sucks to suck. If you're an airline investor, specifically in Spirit. Now, I do know that you can be you could have like traded this thing, but sure, okay, you're that guy. Let's go ahead and plug her right into the model. So we move on from this one and get to the more exciting ones, if I'm being honest. So analysts, again, look at that. They say buy, ignore us because we're stupid. The analysts are smart. And
they are infallible, Fabio.
They're infallible. Look at that book value. Book value is basically at the price. Tells me they probably took on less debt than their peers. They are a smaller company. So there's, what they say, the bigger you are, the harder you fall. And it's a terrible business line, airlines. So therefore, a lot of things can go wrong when you're doing stuff. So 10% right here, boom. They don't have to grow. You can get your 10%. Now, look at that dilution.
Yeah,
Terrible dilution.
they are diluting the heck out of you
Let's
because I saw that book value and then I was like, okay, they're probably likely diluting you pretty heavily. And then I saw average buybacks and I was like, there's the answer right there.
well, the
So
book value is high compared to,
yeah,
remember, Delta and American. They
yeah,
probably took on a lot less debt. I'm looking at their debt levels from based on the difference between the market cap and the EV.
hmm
That's much better than the other guys so far. We'll take a look at the next two. So with this, remember, airlines, I prefer a huge discount for margin of safety because of how terrible this business is. And then the average growth rate over the past years, this is a discount airline. A lot of people are trying to save money. So this is kind of what they're good at. And so I will
this is
put
their
the
like little
average growth.
niche. Yeah. Okay.
Oh, and we actually have to change one thing and make sure that we're doing that. So this needs to actually decline. There we go. I need to remember to do that because I have it standard on 20. So I need to remember to do that. And that averages out. So the long-term goal at some point would be around there. So clearly this thing is not cheap enough. That's what that's telling me. So it looked cheap, but remember, I had to make that adjustment. And now we can see the true cheapness of the stock. And let's say that's where they're going to grow. This is where they're going to grow low. And this is where they're going to grow. Oh, yep. That's where they're going to grow.
Oh,
Meant
yes.
to put 5. And then let's put somewhere in like 7 and then 13. All right, so 13, and then we have the dilution. Let's take away the dilution, see if that changes the story, hopefully for them. No, it doesn't. So I don't even have to discount it any further because it will be a no buy, if I discount it higher than this. So I would avoid this. Also, prediction or risk of bankruptcy. Remember, all of these companies, very difficult business. I feel sorry for them. This is a very unionized business as well. So naturally, the workforce is going to be highly inefficient. It's very difficult to make some necessary decisions to survive. So, that's a give or take, right? And it's already a difficult business to really operate in. They don't really make much money. When they do, it's like you want these companies to be like cash cows because you don't want them to keep your money. Let me just be fair. If I'm kind of painting with broad brushstrokes, being the owner of these businesses sucks. Really does. They are cash cows. You would want to get all the cash out and then don't let them really keep it because they're not really going to do really much with that. So yeah, buybacks galore, dividends galore. Please take out all the money of the business. I don't want it in there. All right. So that being said, let's go look at the key ratios. Let's see if this is any better. All right, much better. Look at that.
Wow. Actually,
Much
that
better.
was very surprising.
Yeah,
But
so
that also makes sense given
look at the score right here. It's much higher than American Airlines was. American Airlines is there. Delta is there. So save is slightly better, right? So makes sense. And then right here, much better. Getting worse, but still better than the other boys. And then this is getting worse, but better than the other boys.
Yeah.
Look at that.
I mean, at least their margins are positive in this instance.
At least
I
their
think
margins
for
are
both
positive.
of the other two that we looked at, they were negative. So
all right. Once again, we can kind of see the fluctuations. Got better, got worse, then got worse, then got worse.
oh
Yeah. But we can see that doesn't necessarily correlate very well right here because it did go up, but it went up from here. Well, let's see. What was the end date here? That's May. So that's still the beginning. So it's basically saying from here to here, it should have gone down. Oh, it did go down. Oh, look at that. Okay. It still kind of correlates. And what was the year it went up? Let me go back. This is just for my own entertainment, everyone.
yeah.
So bear with me. 2018, 2017, 2018. So this is the end numbers. So end of 2018. So it should say, let's take a look. 2018. Yep. So from the end of 2017 to 2018, it should have, where's 2017? There we go. Yeah. So clearly I don't have to drag it. Everyone can see. It's not dragging. Anger courses through me.
Well, we can move on from there and go to the
right,
cash conversion cycle.
All right. Let's see their
this one
strength
has.
here. They're smaller, so I expect less strength, and I am right. Boom. Cool. All right. Moving on.
All right.
Next
Moving
one,
on.
Ryanair. So what do you know about
Ryanair.
Ryanair? Tell me everything you know about Ryanair. And if you don't know anything, then Austin, you're a fool.
I
I'm
am a
kidding.
fool
I'm
in this
kidding.
instance then, Fabio.
I'm
I'm a
just
fool.
joking.
Do
If
not know
you are
anything.
not from the UK, you may not know what Ryanair is. Ryanair is the Spirit Airlines of the UK, of Europe. Okay. So that's how I want you to think about it, or rationalize the existence of Ryanair. So Ryanair, we can take a look at the max, much better performance. Look at that. This is very well-run company, by the way, just so you know. Look at that performance. Sometimes you can find some gems in this industry, ladies and gentlemen. So right down here, if you were just super good at investing, there you go. Why aren't you that good, Austin? Why can't you pick the bottom of things?
I know.
See,
It's
you got
a
100%
skill I will
growth.
acquire with time.
All right. So decent performance. I expect good things out of them. Let's hop into the model. And well, actually, what do you think what we're going to see in the model before I show everyone in the model? What do you think we're going to see?
Probably still an enterprise value higher than the market cap, but less so. And then I would actually expect to see in this instance potentially a positive book value, profitable margins, positive margins, and then a pretty good earnings quality. I would actually, above all, expect to see a pretty good earnings quality in this instance. But let's let the model answer all of the assumptions that I've just made.
So 10%. Let's see how quickly we can run through this. Yes. And let's do the average buyback. I like it. They're not doing too much buybacks in this case. I know I said that with some of these, I want to be cash cows. Ryanair, I think, is a good allocator of capital. And
you got to plug in the ticker there.
I don't want to.
I could have probably told that. I was like, I don't think he wants to plug in the ticker.
All right. So it's a buy rating with 36.7% upside. And now let's see what populates here. So more recently, the return on equity, return on invested capital has turned negative, but we have to see over the longer term what that would be. And you can see here, they're based out of Ireland, right? Ooh. Very nice. Okay. So let's assume some growth rates. So the middle rate, we're going to do 1.8%. Okay. Not looking too good. Yep.
Make sure you click the other plus over there.
Oh no, I already had that. It's good.
True.
So okay, Ryanair, cool, out of the other airlines, is actually the best at converting to cash. So long term, it's actually about 10%. And so what we're seeing here is it's very expensive, or we're gonna have to use this. See right here.
Mm-hmm.
Right. So what we're gonna use is our trusty tool over here.
The recovery calculator.
So we want to see, for example, how long it would take for them to recover, right? And then so let's take a look here. We'd have to see if they want to recover, how long would it take for it to recover, Austin? This is like the art. There's not a science. How long? What year? We're in year 0. Will they recover in 1, 2, 3 years? I'll teach you how to read this.
4. It would recover in year 4.
Recover in year 4. So we have to assume a growth rate of about 32%.
Mm-hmm.
Okay. Does that make sense? That would imply the recovery.
Okay. So this is sort of like our base plate by which we need to start on. Because I mean, obviously this isn't a definitive of this is what is going to happen. This is just more so allows us to points us in a good direction.
Yes. And then afterwards it would be inclusive, but like this still implies the same growth rate actually of the past, right? So let's actually extrapolate from here, or take out the 2020. There we go. So that's how you have to kind of read that. So I removed the pandemic, and I know this is kind of maybe going over some people's heads, but I'm doing my best to kind of explain this tool. So we go to year 4. You said they're going to recover here. So this is the growth rate it would require, right? And that would be the compounded one. And then if you average that out for 10 years, right, after that, using the average, it tells me to include 18%. So we'll do 18%. So that's where it would be. That would be implying we're going back to normal, and your assumption of recovering at in 4 years.
So now my question is, we're seeing it trading at a price at $99. Is there anything to suggest that sentiment towards Ryanair is, I mean, obviously it's bullish, but is there any, like, why do you think this might be? Why do you think there might be this level of
Well, let's take a look.
Investor sentiment.
Let's take a look at this, right? So they've actually recovered very nicely. So it's already priced in the recovery. That's what that's telling me. The numbers are telling me that they've already priced in the recovery. This is one of the best well-run airline companies, but they've priced in the recovery. So they are expensive. They are the most expensive of the bunch, according to the model. And you can see here, right here, they my model is actually not returning to me because it's IFRS, and it's not returning to me my own presumption. But we can take a look at the smell test of the Altman Z-score, and it's much better than the other ones. So, you know, if we look at the key ratios, we're probably going to see something better. But I'd have to assume a tremendous amount of growth rate. I think I have to assume 30%. And assuming the required rate of return, it's just not a good risk reward, in my opinion, for an airline. It's not. However, if you were able to have gotten it at around the pandemic, that was actually a very good risk reward, because we would have assumed the recovery, and they still just haven't recovered yet. So if you assume they're going to recover in 4 years, you know, that's something else. But if you assume they're going to recover in 1 year, they're going to grow at 209%, and then implying the average, right, that they've grown before pandemic, that'd be about 21%.
Okay.
And that's supposed to be like your mid ground. So if it's like as if you're using this, right, the average growth over the past 5 years, or the average growth over the past years, then you would be using that equivalent number, because that also implies recovery. That's what this tool allows you to do. Make sense?
Yes,
Sort of, kind of. Cool.
Yeah.
All right. So
let's move on to the key ratios now. I'm curious to see if the assumptions I had walking into this are actually
good. Looking good, sort of better than the other ones. Looking
interesting.
good.
I mean, obviously what the gross margin is telling me is that since 2020 they suffered the same amount, but now they're starting to slowly recover from that period.
Here's here's something going on with like price war or something. Something's going on there. All right. What do you predict? Earnings quality.
I bet you it probably a decent earnings quality.
Good.
Oh,
better. No, look. Better. It's improving. Better.
And
then
boom.
destruction.
Wow.
Yep. And I have to make sure that when it does this calculation, it's not how it's calculating, because, you know, IFRS throws in some little difficulties, but let's take a look. Correlation. So you see how this is, but we found one, right? Correlation does not prove causality. So here's a stock where the correlation is probably very weak. So improvement across over the years, and then decay all of a sudden. So actually the decay happens while the stock price is going up. Or is it? Yeah, here we are. So the decay is going on from 2020 to 2021. At the same time, the stock price is actually moving upwards. Boom. Correlation has been broken, but that's why it's a correlation. It's definitely not the causation. So I don't like to see this. This is a bad sign for me, but it could be improving. It does tell me so far, with everything kind of putting it all together, I am cautious. I would not be buying this, but I do like the management, how they're running the business, but that's separate.
It's just still like, given the macro of the industry it's into, you're still kind of like,
yeah, exactly. All right. Awesome.
Wow.
Cool. But again, this could be IFRS messing with this. So
yeah,
put a star on that. All right. So conclusion, not for me. Definitely more expensive than really. I think it's too expensive to really hop in. Airlines. I think Rob, the popular investor, he just kind of came to that same conclusion. I don't know, because he liquidated his Southwest Airlines, which we're about to look at Southwest, which is Austin's favorite.
Well, I wouldn't say it's my favorite. It's just the one that I know, because that's usually the airline that my family and I used to take when I was a child, when we would go to Florida, when we used to live up north forever ago. But
it's your favorite.
Sure. Maybe a little bit. Maybe I have some LUV bias, you know?
All right. So what we're going to do is we're going to take into account, I already have it. Let me actually plug it into this. We can see the price movement. All right, everyone. The moment you've been waiting for, Southwest Airlines, the one that is the most favored among the value investors, if they had to choose an airline and they had a gun to their head. So Here, we'll talk about why that is, Austin, because honestly, of all the airlines, this one is the best run. We'll see why. So if you had invested in IPO, congratulations. You are up 8,000% over a long period of time, which is not that good, but pretty good. Okay. There's other worse places you could have put it. And since going back there from about 10 years, 363%, I think you may have outperformed the market. Let's actually take a look at that. And then we can compare it to the SPY, because I don't want to say that and then that not be the case. So we have to make sure the time interval is the same. If not, and unfortunately we can't do 10 years. What a bummer. Okay, because if I do max, check that out. Look at that. Well, since the you see, you can't even measure this way. Let me explain why. Compounding interest, ladies and gentlemen, you can't measure it that way, because if you do, Southwest has all of these years extra of compounding while the SPY didn't exist. That's why it looks like that, right? But you would have to find a way to measure them exactly on the date. Let's see if it does it. Does it? If I click here, I can't tell if that's the no. So you see, it's there, right? It's giving you 877%. So there is a formula you can use to solve for that. But basically, at the inception, around the inception of the SPY, this company has almost a 10x ahead. So of course, it keeps compounding. It gets worse and worse and worse. Does that make sense, Austin?
Yeah, it does.
Sense? Okay,
it makes sense.
Cool. So that being said, actually, I think just based on that, it may have slightly outperformed the S&P since the S&P has started. But anyways, regardless, we want to have this open while we take a look at this model, a lovely model. Buy it, ignore us. We're too stupid to understand why this is a buy. The analysts are infallible and they say it's a buy. So it probably might be a buy, right? So 10% discount rate. If it doesn't grow, we buy this thing at 19 and we'll make 10%. Buybacks, let's assume these buybacks are dilutive and basically they're issuing more shares on us. And there we go. Let's also assume that the growth will be averaging around, well, let's use a cyclical calculator. Austin, when do you think they're going to recover? Do you still think 4 years?
Yeah, I'd say 4 years in this instance. Yeah.
Okay.
I mean, just in keeping with what I gave it for Ryanair.
Okay, so 4 years. So we'd have to grow compounding at 8.5% if we assume they return back to normal growth. So 8.5% will be the middle. And oh, look at that. We're actually almost there. Finally, one of them. We're almost there. So 10%. Oh, gosh darn it. So again, because these are airlines, I would be discounting these very heavily. I've already adjusted the cash flows. I gave them the highest of all of them. So they're about 11%. And that's kind of giving them being a little bit generous. So the book value is about 17. We have that. Doesn't really matter too much, but just to show something. PE, they're not profitable, but they're cash flow positive, just barely. They look very expensive on a cash flow basis. But again, we are assuming a recovery before anyone thinks that. We're assuming they recover and then surpass that and return to normal growth. They're just too pricey right now. So you want to see the price come down. Maybe Rob noticed this. Okay. So that's what you have to think about. They're too expensive. They're pricing in too much too soon. Okay. So if they can come down to, let's see where they ever crash down to. Oh yeah, no, this company, I guess is, this company's been perpetually cheap. I would not be touching this. I would be touching this if the price came down significantly. And that might be hard to hear, but that's my opinion. I will be different from you. It's a market. We can disagree. It's fair game at this point. All right.
Yeah.
So if I don't want to buy your asset, don't be upset. All right. It's just how it is.
Oh, wow.
So look at that. Like I said, Southwest, the best run of all of these businesses. Okay. Look at that. Liquidity ratios look beautiful. They've improved a lot, but just like their brothers, not too good in the past years, but that's kind of normal for airlines. That's what we're seeing. Debts is going to be the lowest out of all of them. In fact, they have more cash than debt on the books, by the way, if you didn't know that, Austin. And then gross margins also suffering. Nothing really interesting to see here. All right, let's take a look at that.
1,479 for earnings quality.
So So based on that, I think this one correlates a little bit better than Ryanair. Remember, all you got to think is it's great, but clearly something is making it worse.
Yeah.
So we should see somewhat of a correlation, and we do see like it's been steady, and then when the earnings quality declined, we had obviously COVID, and then it rose back up, it roared higher, and then that was the drastic change in earnings quality, and then that's what the measure is kind of telling me. If that's how I read it, it is my own custom measure, so like I will tell you how to read it, Austin. But I mean, I've already explained to you the rules. Basically, above 1 is good, below 1 is bad. That's how you read it. Don't worry too much about like the size. It can indicate, but like when it's such a change like that, okay, don't take it too literally. Okay. Let's take a look at the activity ratios. Very good. All right,
nice.
cool.
Yeah, good.
Powerful. Awesome. All right, Austin.
Yes.
Would you buy this one?
No, I would not.
Would you buy any
one.
of these?
No. If you had a gun to my head, I still wouldn't buy them.
Oh, so you take the bullet?
I would take the bullet in this instance. Yes.
But then you can't invest ever.
I know, but that's the price I'd be willing to pay.
All right, you heard it here. Austin would rather die than invest in an airline stock. So, wow, that's harsh words. Okay, now you made everyone who owns this cry because you're telling
Don't
them
worry,
that you're not going to buy their
it's
shit.
nothing. It's nothing against the airline holders personally. It's just me. I would never go anywhere near these. This is
a terrible business. I'll just tell you, this is a terrible, terrible, terrible business. Not specifically Southwest. I'm talking about the industry. It's
industry.
Terrible.
Yeah.
I would not want to be involved in this. Buffett, I think, realized that, and he sold out of all the airlines because he's like, oh, I don't want a part of this. He sold when the price was lower. Can you imagine? I think he was super right, because even at those lower prices, which each and every single one of them, we saw the fundamentals just weren't there. He has a greater ability to see that, in my opinion, than even what we can come close to. And what we came close to is observing that even at these prices, I don't want to touch them.
Well, I actually, if I can offer a commentary here, I actually think this is sort of an interesting lesson on just like investor psychology as well, because I know a plethora of people, my own immediate family included, who are invested in airline stocks, and their thesis is that, oh, people will always be traveling, airline travel will continue to expand, therefore airline companies will never go away, people will always need them. They view them as a need basis. But it's interesting because what I saw here today with the story that these numbers were telling me is that these companies, it's a quick turnover. It's almost as if you can't even make a bet on one specific business, because even if that business is good, it's still in such an industry that has such a quick business turnover that it just, the risks do not really seem worth the rewards in this instance. So yes, if I had the gun to my head, if you had the gun to my head, I would take the bullet in this instance.
I would rather invest in the picks and shovels, because I agree with your family member, but why would you touch these? Why not go for the plane makers? How about that? That's a better one. Or the travel companies like booking.com. I'm not saying their values right now, everyone. But they were
like keeping with the philosophy that you're kind of showing here, because I mean, if you really break down that philosophy of what you just kind of said there, why would you invest in the airline businesses where there's such high business turnover itself, when you could invest in the manufacturers that then sell these planes to all the different airline businesses? And we know that the airline customers will always be there because of the fact of how many people use airline travel today. So why wouldn't you buy the company that is the DNA instead of buying the ones that, there's so much risk in the industry itself. Yeah. What
we call that having the right thesis, but the wrong execution. So your thesis is correct. People will always travel. Good on you for saying that. All right. How are you going to play that? Right. It's like I say, like, you can identify bad policy in the world, right? You see a government doing something and you're like, that's stupid. All right. How are you going to profit from that? That's the next question. And then is the way you're going to go about it the right way? Harder question to answer. But with this, you're right. Thesis is people will travel. How are you going to play that? You're going to buy the airlines. You're going to buy the plane makers. You're gonna buy the travel companies. I didn't even mention, we got Airbnb. I think Airbnb is a better company than any of these airlines, even at current crazy valuations or potential crazy valuation. I haven't even done really an analysis on Airbnb. It's just kind of like a smell test. But the other one, Expedia, you got all these ones. Expedia owns hotels.com. You got the hotel, not the owners of the hotels, but the hotel brands like Hilton, Marriott, International, Hyatt. So those all benefit from travel. Why are you not thinking about those?
Yeah.
Um,
Well,
there's
I
so many
mean,
ways to
yeah.
play the same thesis, but like the airlines are just a terrible way to play it. And that's why I think Buffett figured out.
If I'm being honest with you, after this video, because now this is the discussion part of the video where
Yes.
you and I just
Breaking
have
down.
a yeah. If I'm being honest, I'm actually going to probably look into Airbus, Boeing, some of the plane manufacturers, because I think there, as you just indicated, I think there's a real credence to the philosophy that okay, we know airlines are here to stay.
Well,
However,
Austin.
just my own thoughts. I know that we've made videos on it. We've made videos on it, but I think I'm going to start to do like my own research into it as well, because adding on to the nuance of these, I still think if it's favorable for me, if I can find a favorable price for the airline manufacturers, I think that we're kind of in that period now where it might be an opportunity to buy because we're just coming off of the throes of the pandemic. But this is just sort of a preliminary thought that I kind of have going into this. It's just two guys discussing it now at this point.
Okay. But be careful with the price you pay.
Yeah.
So
Yeah.
there's so many layers to the questions you have to ask. After you answer one question, there's always another question you have to answer. So again, the first question is, what's your thesis? Travel's gonna return. Cool. You got the answer to that. How are you gonna play it? You say, oh, Airbus and Boeing. Cool. Okay. Next question. Which one? Okay, let's say you do an analysis on them. You prefer the business, Boeing or Airbus. Maybe you have to do simultaneously a financial analysis to do a smell test on which one is providing the better value. Cool. Then you find the answer to that one. And then you figure out how good are your assumptions? Is the margin of safety presented good enough? Cool. Then you answer that. Then you answer the final question is how big is the position going to be? Right? The hardest one. That's the hardest one. Because if you don't, the variance of your performance will, for lack of a better term, vary drastically. Mm-hmm.
So now my question is, I'm sure there's someone in the audience now who's watching this. If you guys have made it this far, congrats, you guys are the best. What are your thoughts on someone who would say, okay, well, we know that there's such high business turnover in the airline industry. Why wouldn't I just get an index fund that covers all of them? What would be your answer to that?
Why would
Well,
you
I mean, no, no,
why
no,
would
no,
you
no, no, no.
index a terrible business?
If you still wanted exposure to the airline industry, keeping
Yeah.
up with the thesis
Uh-huh.
that airline travel will never go away,
Mm-hmm.
what would you say to someone who's like, okay, why would I want to own one particular player when I could own the entire index itself?
So you
Where I
just
could
want
own, I could hedge my investment thesis and hedge my bet on the fact that airline travel will never go away and continue to expand, regardless of which companies keep coming and going. Therefore,
so you
I could
want to
just own the airline index.
so you just want to own all the garbage,
Yes,
not just one
I
of the
want to own
garbage.
the entire trash can, not just the piece of
You see,
trash.
that's basically what you're telling me. But I mean that comes from the conclusion. That's why I reserved my thoughts to the very end. Here's where you're hearing my thoughts about it. Yeah, why do you just want to own all the garbage? Is that the goal there? Like,
Yeah.
I want to index myself to garbage. Cool. You're probably going to underperform the broader market because the broader market has really good companies in it. So opportunity cost. Why would you do that? You're getting less diversification by owning the index of airlines, and you're probably going to underperform the broader market again. There's only a few airlines that will outperform the market. The rest are going to underperform the market. Ergo, the ones that are outperforming are not going to make up for the performance of the underperformers because the majority of the airlines will probably underperform, if we're being honest. Mm-hmm. And like I said, if I had a gun to my head and I had to pick one, I will not die on that hill, Austin. I will pick one because I'll continue investing in other things. But I'll buy Southwest. And if Ryanair gets to the price I like, definitely Ryanair over Southwest. But there's so many other airlines we didn't cover. Like we didn't cover United. We didn't cover what's the other one? JetBlue, that one, and a bunch of others that are probably out there. that people are like, wait, what about that one? But if you bought
What
the
about
index, why? Why would you do that?
now? Sort of another question. This would be my last question before we wrap up the show here today. What about to someone who's now probably logically thinking, all right, well, time for me to buy puts on these companies? What are some words of advice, words of caution, words of encouragement, words of pure cringe that you might have?
Where's a
that you-
pure cringe? Well, why would you buy puts?
Be- because we know that the companies in this industry, there's such a high turnover. And we know that there's other companies that are saddled with debt currently at the moment itself. Therefore, you can kind of hedge a hypothesis. Okay, this company has an exorbitant amount of debt. I'm seeing a complete degradation of the balance sheet. Therefore, I'm going to buy puts on this.
Okay. What is the price of those puts? That's what puts are just like any other investment. What's the premium that you're going to be paying to buy those puts relative to the performance you expect? That matters. Then again, well, then exposure after that, if you make that decision, but which one? And then is your analysis going to be driven by sentiment or by fundamentals? Is the market currently reflecting fundamentals or sentiment? Right now, I'm thinking the market, based on what we've seen, all these stocks are not fundamentally driven. They're sentiment driven. So Buffett looks stupid. He looks stupid selling low, and now they're much higher. But I think Buffett is not stupid, right? Oh, very, very bold claim, right? Very bold claim I'm making.
Based. It's very based.
But in fact, he was driven by the fundamentals. That's what I believe drove him to sell the stocks at much lower prices than where they are today. He saw the fundamentals. He didn't care that the market sentiment was going to be more positive than the fundamentals. And he just said, I'm out. All right. Good on him. I think he did the right choice. In hindsight, if you somehow knew that the prices would have gone up, of course, why not sell it to a greater fool theory? Why not sell it to a greater fool than I? But I don't know if that was Rob's conclusion too from the Popular Investor channel. But I'd imagine he saw something along those lines and then he's cut his losses. He's like, all right, I'm out based on the risk. But I would have said to him if we were speaking or that these things are not priced as cheaply as you really think. They're very expensive. And they've recovered way too quickly. So they've gotten ahead of themselves. And with these things, you really want to discount because they're very bad businesses. They're very bad. I would not enjoy being the owner of this business. It's too complicated. And going back to the index answer, why do you just want to own the whole garbage heap? You're going to underperform the broader index. You would rather it'd be better off owning just that. You'd be better off.
Yeah. All right. Well, with that being said, we are your hosts, Austin and Fabio. This is the Capital Mindset Show. Please be sure to visit our website at capitalmindset.org and like, comment, and subscribe. And also share the video. Really, really helps out the channel. If you've made it this far, you guys are the best. And we will see you guys later. Take care.